Hello, I want to welcome everyone participating in today's webinar, Introduction to Indirect Rates under Uniform Guidance. This is part one of our four-part webinar series, the Indirect Rate Toolkit for Nonprofits with Federal Grants. GRF CPAs and Advisors, formerly Gelman, Rosenberg, and Friedman, and I will be today's moderator. I'd like to start off today with some quick housekeeping items and explain what you will need to do to earn CPE credit. Participants seeking CPE credit today must complete and submit a short evaluation survey that will appear automatically immediately following the webinar. You will be asked to recall these words in order to receive them. Please write down the CPE words when they are given and keep them until you receive your certificate, as they will not be provided again. If you have any technical questions or issues during the webinar, please use the questions function to speak with our webinar administrator for assistance. The slide deck and recording from today's webinar will be made available for download after the webinar has concluded. You will also receive a follow-up email with direct links. Technical support and CPE questions may be addressed to Nathan McLeveen at mmcleveen@grfcpa.com. Today's learning objective is to provide an overview of the impact of UG on indirect rates and allocations for preparing a nonprofit indirect cost rate proposal. One CPE credit is available for this webinar. And with that said, I'd like to introduce your presenters for today's webinar. Paul Calabrese is a principal in the firm's Outsourced Accounting and Advisory Services Group. Mr. Calabrese brings a successful track record of working with both nonprofits and government contractors. His remarkable career includes positions with the Air Force Audit Agency, DCAA, and 3 government contractors, in addition to 20+ years in public accounting. Tricia Catabini is a senior manager in the firm's audit department. Ms. Catabini has worked in public accounting for more than 13 years, specializing in serving the nonprofit sector. And with that, I will turn the presentation over to Paul.
Thank you. Hello, everyone. We're hoping you have a good day today, and Trisha's with me. Say something, Trisha.
Good morning, everyone. Thank you for joining us.
Great. So today we're going to be talking about indirect rates and the rules with the uniform guidance. There are 3 other presentations that we'll do that will deal with cost principles later, and as well how to build and put together one of these indirect rates. I hope that there will be some people from like universities and local governments, tribal units, all of the municipal groups or hospitals, the large nonprofits, because most of those people will be dealing with the nonprofits as subrecipients, and they'll have to understand how the indirect rates work. So even though the college and university have its own format, they call it a short and a long form, and they're very complicated, they still need to manage and monitor nonprofit indirect rates. So with that, we go into just some interesting things. That FAQ comes from the COFAR. Unfortunately, the COFAR no longer exists, but it was the group that put the original uniform guidance together, and they had interpretations, and you kind of get the insight as to what was on their mind when they put this together. So basically, they wanted everyone to understand that there really is no requirement that you have an indirect cost rate. No one's going to force you, but of course, that's not a good business decision, because you want to recover your indirect costs. And if you're fortunate and you don't have match, you might break even, because you know you can't have profit on a grant. So also, I guess the COFAR recognizes that some entities might just say, after hearing what you have to say about putting a negotiated indirect rate together, we'll stick with the de minimis. Before, years before, they didn't even have the 10% de minimis. So this is a pretty good deal. And there are instances where I've seen it with a particular entity. They had some work with the Department of Justice, and their rate came out high. It was like 45%. And so they voluntarily reduced it to 30. So there, yeah, you can do that. You can reduce your rate, your indirect rate down, and negotiate that down because you feel that it's more reasonable for your client, the funder, the federal government, or one of the agencies. And some people might do it because they feel they want to preserve the program piece. And internally in a nonprofit, sometimes you get a little bit of push and pull between, the program people want as much dollars as they get. You can't blame them for that.
Mm-hmm. And I say a lot of times from my perspective, the clients that I work with in the auditing world, Paul, I typically see some who have a very small program that is federally funded. So from a burdensome administrative aspect, they also voluntarily waive even doing it indirect just because of the time that it might take. They're funded elsewhere. So they typically can cover those costs with some of their other private funding.
So they'll use the de minimis, right? There also is situations, I know I've dealt for many years with Ryan White, payer of last resort. And sometimes people they have a 10% cap, and they can use that 10% cap for not only indirect administrative, but direct administrative costs. And so because of that, they don't have any more money that they can recover for truly indirect. I mean, it's just the way the program is laid out. But the agency, and that comes under HRSA, under HHS, they can still make a request to HHS, HRSA, and say that, we want to have a rate. We want to negotiate, and they'll come back and say, yeah, but you don't have, the capacity, we have a 10% cap and you spent it. But they'll come back and say, but we want to get other HHS awards that don't have those caps. And so at least if we're limited and so forth, we get the advantage of getting that negotiated rate if they want it.
Right.
The de minimis rate, the DMR, yes. It sounds, more sophisticated. So the de minimis rate is a 10%. Now, you're supposed to only get the de minimis rate or use it if you've never had a negotiated rate, but there is some proposed changes, and they may remove that. It's based on a modified total direct cost base. We'll talk about that later. And, you can use it until you get a negotiated rate. They want it to consider both direct and indirect costs, not to have any of that bad double charging, and use it consistently. One little example here is I try to explain to people the difference between a NICRA, a negotiated indirect cost rate agreement, or a negotiated rate, let's say for step 1 and 2, versus just having a de minimis rate. And let's say, because it does say on the de minimis rate, you got to follow the modified total direct cost base, which again we'll talk about later. But a lot of us know that subawards, beyond 25,000, they have to be removed from the base. So if you look at this simple example and you say, okay, well, they started out NICRA step 1, and it's 100 over 1,000, and that's 10%. In the second example, okay, we have to remove our subawards, and let's say it goes from 1,000 to 500. Well, the rate then adjusts to 20%. 20% on a 500 base is still 100, so you still have basically the same. Under the de minimis rate, it's fixed. So what happens is if you had to take your base from 1,000 to 500, then the 10% times 500 is only 50. So there is a difference there, and we just wanted to point that out to you, the impact.
Mm-hmm. Do you have any just kind of advice though for some organizations out there that may not even be using the de minimis rate. I see a lot of obviously uniform guidance reports and audits that we do, and they elect not to even use a de minimis rate without even a NICRA.
Wow. Well, the advice is, do you want to be an ongoing or going entity? I mean, you're hurting yourself. You are entitled to it.
Right.
And so you should do that. Now, I do know in the case of the National Endowment for Arts, NEA, that many of those do not have any indirect, and they will not let you use any indirect. They're just direct. But except for those exceptions, yes, I would. Often, isn't it in a grant application? It's a little pull down. It's so simple. You say, do you have a negotiated rate or do you have a de minimis rate or other, maybe because you're a sub to a prime or something like that.
Right.
But yes.
So the advice is to at least if you can't take the de minimis rate.
Unless for some, again, the reason was they want to preserve all the costs for a program.
Right.
But they have to understand that there's administrative cost to everything.
Correct.
So what happens if the passive entity doesn't honor, a NICRA rate? Did we skip one?
Skipped one. I'll go back one.
Okay. Can someone move it back? It's that simple. Okay. Our apologies. PTE is a passive entity. It is effectively the prime for which there are subrecipients or subawards. So if a sub has a NICRA, the passive entity, the prime, should honor the NICRA. There are some issues there where some primes are not doing it, particularly the municipal governments. Do you think you'll ever win your case? That's going to be very difficult. You have the option to negotiate with the sub or offer the 10% de minimis, and if you do, it stays at 10%. And again, they're supposed to honor that rate, and if not, there's remedies. I forget what they call those conditions or some special conditions or something like that. So make sure you're, find out how these things are set up ahead of time. So as you move into those grants, you know what the whole situation is. You'll look at what might have to come out of unrestricted net assets to cover the difference. But it's certainly better than a program you're doing yourself where there's no funding.
So true.
So, okay. So if you're applying for de minimis and you have a break in a federal relationship, right now the government would say, we're sorry, but you can't use the de minimis rate at this point if there's a break in a relationship, meaning you had a prior negotiated indirect rate. The hard luck thing that they have here is, well, the government says you had the experience, the money, the resources, so what's the problem? Well, things change. And maybe de minimis makes more sense, or they did this even before the uniform guidance came into effect. Well, this will be changed, possibly. De minimis rate in a single function, that's non-federal entity. NFE is a non-federal entity, which is anything but the federal government. And there are some rare cases, I've seen it with NSF, National Science Foundation, where they just fund to do this one project, and that's it. And so you're really there doing the project. Yeah, there's some little bit of quote unquote indirect or overhead, but they consider it direct. They consider it a part of what they're doing. So in that rare case, you would not be offered a de minimis rate. It's very rare. So that's the one thing you asked me a question before, what should we do? But in most cases, if you got it, you should get it.
Right.
And the other thing now is you can extend, once you have a negotiated rate, up to 4 years. Why you would do that, I have no idea. And I may say that, a little facetiously, but I believe as a cost accountant, that's my real deal. You should know what it is every year. and it will change. It is a pain to put it together. I mean, as a minimum, you should at least calculate it. But if you've gone that far and you've done it in prior years, the submission, the documents that the government wants isn't going to change. Like if you had to have a cost policy statement, you know, you're going to change the year and a few basic things, and it's the same. You've got to know what your true costs are, and the indirect, the burden is so much a part of it. What would you say?
I mean, I think from my perspective, I work with a lot of small nonprofits. So they may go through that challenge, and sometimes it can be a challenge, as I'm sure you well know, of putting together a negotiated rate, and the process can take a long time. So some of the clients that I have do go ahead and take the 4-year period simply because they don't have to do the calculation year over year over year. Yes, they obviously would want to, from an accuracy standpoint, really understand what their true costs are. But when you're working with a 2 or 3 person shop,
oh yeah,
it can be very burdensome. So their time is much better well spent elsewhere on some other programmatic areas, or even finance functions of strategic planning or whatever it might be. So that to me is, you know, something that I would step in and I would say, okay, well, clearly you've done your due diligence, you've done your process, you understand strategically what the organization should be doing, but you've made a decision ultimately to spend your time elsewhere. So at least they're recouping some of the costs. They may not be recouping all of it. In some years, you know, they may recoup more of it.
Yeah.
So it's really a decision process that is sometimes, I think, wisely made.
So you're saying that, you know, yes, that's the indirect rate. You're saying that in a year where their actual costs are lower, you believe that they could obtain that additional amount. Say the actual rate was 10%, the provisional for 4 years was 11%. You're saying that they're entitled to that additional amount?
I guess that depends on the audit.
Right. Yeah, it's usually yes if it's, you know, if actual's higher, that's fine. But if it's lower, then the government usually, right. The only exception though is with the de minimis rate. It is 10%. No one's going to review it. No one's looking at, you will get the 10%. So if you really had an 8%, you could be making money. So it's an interesting thing. All right. And there's just some basic things to know about cost allocations. And I would say that, first of all, what's really interesting, and this has been happening for a long time, the administrative staff can charge direct. Yeah. And so when they do that, and this has been, like I said, they're just officiating what I think everybody was doing before. What we're talking about is like a small entity where people wear many hats, and the accountant could be doing some really just for that grant, some support, like the budget applications of paying, maybe, yeah, those types of things, the draws. Those are time, I mean, you should have backup, right?
Right.
And so, yeah, you could, or you could be a CE, I mean, an executive director. It could be they're a technical expert. And so they're going to put some of their time. That's fine. Just, we think we would appreciate it if you would have time reports. That means then as an ED, if you want to recover some of your costs direct and supporting, fine, but you're going to have a timesheet for everything that you do.
Correct. Right. So I think one of the pitfalls is that some organizations, especially when the new uniform guidance time and effort rules came into place, you know, several years ago at this point, they got into an arena where they weren't tracking the time as accurately or to, you know, in the area that they really needed to. So you would see 1 hour here, and then you'd see 7 hours of admin time, which we clearly know can't really fall under those time and effort requirements. They need a little bit more due diligence when it comes to that tracking.
Yes. And even if you're talking about time reporting, what if they charge like a fundraising or membership, if applicable? Then those actually become direct but not recoverable kind of things. So use the time report, but you know, anything with administrative wages, in other words, you have Susan, Sally, Joe, You know, if there are people that normally don't, not the program people, you know, they've got to be listed in that budget, because ultimately the budget is the authorization to spend funds. Okay, and then you've got to be able within your time reporting to say, well, they charged direct. Therefore, if they're 5% direct, that means 95% indirect, but they're not indirect. You can't make that direct. You got to make it clear between direct and indirect. Hope I didn't confuse anyone. So there is a direct cost principle. And basically, if you can allocate something very simply to 2 or more objectives or to grants, then you're able to do it and keep it a simplified thing. And this was something we were talking about when we were preparing. And that is that indirect rates, and even this concept, is to keep it simple. And it is amazing, the smallest of small entities sometimes that do use these indirect rates, it gets very complex and they don't need to, you know. It really, if you're still keeping copier charges, you know, I mean, if your phone system automatically does a long distance call, I can see that. But, you know, just some of these allocations with logs are just like crazy, aren't they?
They are. They are. But I mean, again, that's up to the organization and what they want to put their time into. So.
But the government accepts something a little bit more straightforward and simple.
Yeah, an easy, simple Excel workbook.
Yeah. So it's just something to think about. So in this case, a summer workshop, if it were 100,000 and you pulled all the money together for taking young students to a college campus to get them excited about college while they're in high school, the hosting costs, the training costs, just those 2. And let's just say it all came to 100,000, but 2 grants, you had 30 people on one, 70 on the other. It's literally 70, 30%. That's simple times the 100,000. That's what the government's trying to do, trying to make things straightforward. If you can't do it on some straightforward basis, then come up with some idea, please. But to actually have to charge, see, it's simpler. You may not get the concept, but put it in a cost center, put it somewhere that say these are joint costs for programs or something with a method. It's so much simpler. But like you say, any entity can, of course, can choose whatever they wish to, just like they don't have to have an indirect rate.
Right.
This is the whatever happens in Vegas stays in Vegas concept. Purchasing equipment, if it goes to one award, well, whatever happened on that award, it stays on that award. The equipment may move after the award's done, but it stays on that award, just like the Las Vegas kind of concept. All right. Unallowable activities, which we'll talk about later real briefly, fundraising, membership, their lobbying costs, those types of things. And whichever one?
I said alcohol. Oh,
Yeah.
activities.
Yeah, just the general activities. They would be treated as a direct item, receiving their portion of indirect. And the other item here that's probably worth is that you will have a determined amount on an indirect, and that's great, say it's 15%. But if you have a cap of 10, you get only the 10. So, and differences to fund deficiencies can't be removed from one award and moved on another award, because that's really fraud. Yeah, what do you say? Yeah, it's not right.
Definitely.
Yeah, because they're separately funded, and you can't play with that funding. I mean, you got to use it for what it was meant to. And then it says payments made for costs determined to be unallowable must be refunded, including interest, to the federal government. And then they talk about different ways that things could be made unallowable. So.
Okay. And I think really the real reason for making sure that we understand what is allowable and unallowable, right, is if you are subject to that uniform guidance audit, and even if you're not, quite honestly, you still have to be following the compliance requirements. But if you do meet that threshold, ultimately, if I came in and I did an audit of those costs and I found something that was unallowable, I would have to give you a finding, report that to the federal government. OIG would come step in potentially and also see that impacts your future funding. So, you know, in reality, we have to work with the organizations to make sure they understand what's unallowable and what's not from an activity standpoint, just as much as different costs.
And those reports are made public.
Yes.
And since your total sources of funds are not just the federal government, it's probably, like you say, a smaller piece than the other awards that you might get from private funding. They may find out and that won't make them happy.
That's correct. Because I say most of the time our private funders also request those internal control communications, and every uniform guidance report has those internal control findings. If they happen to find something, that would be something that likely your private funder as a grantor would be requesting to see.
So like a management report of any type.
Exactly.
Okay, sorry I went too fast. What happened there? What did I do? Okay. It's the mouse's fault. The mouse has its own mind. Okay, this is a newer certification. And basically what it's saying is, you know, think about the ways that you're getting money, the budgets, the annual or fiscal reports of vouchers requesting payment. So what they're saying is that you're saying, to the best of your knowledge and belief, all the stuff is accurate. And we'll go into a situation where it wasn't, and it just blows our mind because why didn't anybody pick this up? But the last piece also is similar now to the way that the government contractors, that there's things like administrative penalties for fraud, false statements, false claims. So be aware of those kinds of things.
All right, thank you both. So with that being said, we've come to our first polling question. And our question is, if I work on a federal grant, the implications of the False Claims Act is when A, I round up to the nearest 15 minutes on my timesheet rather than recording 8.75 minutes. B, I am working on grant XYZ, but charge the ABC grant. C, my time charges are recorded by my supervisor when I'm on vacation. D, I did not receive a formal work authorization to work on this grant. I only received an email from my supervisor. Or E, none of the above. So please take a moment now to answer. While everybody's recording their answers, I'll provide the first CPE word. The first CPE word is grants. If you wish to receive CPE credit, please jot these words down because you're going to need them for the survey following our webinar. Again, the first CPE word is grants, GRANTS.
So it looks like from our poll, about 80% of you answer the question, I am working on grant XYZ, but charge the ABC grant.
And that's the correct answer. So we have some really smart people out there. Congratulations. All right, so we'll move along. So talking about these things, we're trying to get you ready for I can't believe type of stupidity or whatever that Columbia University, they got in a situation where basically 12 years or so, yeah, right, 12 years, they applied the higher on-campus rate, which is where their facilities are, and it's about 61%. And for a university at and on campus, those rates are kind of right. I mean, that's what it is. It's a lot of infrastructure. Now they also could have they were, I believe, performing actually at a lower off-campus indirect rate of 26%. So the delta was quite a bit. Look how many NIH awards there were, grants, 423 were performed at the off-site, and they had to settle and pay $9.5 million back. So, hey, they knew that they did not own or operate those facilities, and the offsite rate would have been much lower. They submitted certified federal financial reports, which is the SF 425, which in most cases, most agencies, about the time that the SF 425 came out, everything started to become automated. So it's almost like it just disappeared, even though it was, we've developed this new form, we got rid of the old, I don't know if it was a 269 or some other odd form, and they combined it all together, and then it was all automated. Many large agencies are. When preparing grant applications, they use the on-campus indirect rate. So it was a whistleblower issue. And the only thing I could say is that for all of, especially the larger institutions listening, you have to be proactive. There has to be, for that size, I would think they would have internal audit.
Yeah, and one of the things that, I always talk to my clients about is that, yes, as a part of uniform guidance, you have to have your proper internal controls that fall under COSO. So everybody knows that when you are submitting these FFRs, there's the requirement from an internal control perspective that someone should be preparing it and then someone should be reviewing it. And the person who's ultimately reviewing it, hopefully, is the person that's signing it and submitting it. Be very, very careful about just a blank rubber stamp when we go to review it. So that's one thing that I always talk to, my clients about is that, yes, from our perspective, we see these sign-offs, but making sure you actually take your due diligence to go through and review what you're actually signing off on, because we all get caught up in it. Sometimes we get very busy, so we just want to push things forward. But as you can see, this is something that was very egregious. And
for many years.
And for many years. And it baffles me how it wasn't caught by whomever was submitting those reports, or even the auditors, or if, as you said, an internal audit function. So again, just be very careful about the rubber stamper.
Maybe one way to get around it is just to have a checklist. If the signature happens when you've gone through this checklist, if it helps. Okay, and there's also a certification of indirect rates or indirect cost. This is the same that the government contractors have to do, that they've now, and they've actually, I always had it. And basically what it says is that you don't have any unallowable or inallocable costs. And if you don't provide a certification, it isn't just that the agency could disallow a cost, although they give permission or some other rate. The real issue is the government's not going to do anything with your rates. I think it's going to sit there because they want you to, kind of, say, hey, I'm behind these rates, almost like a SOX kind of thing with the financials, or, that kind of thing, that a couple of high people sign off on that. Right. People still follow the SOX stuff at nonprofits unless the states do.
Not so much for nonprofit organizations,
but New York did, I think. A couple of states actually adopted some of those. Okay. Negotiation of rates. It's wonderful. The government always starts out with highfalutin language, right? And they say, you guys can basically do whatever works for you, whatever kind of system is best. But then they put you in a box, most of the agencies, because they don't have time. So they're gonna HHS's, that there's certain unique ways you could do things, and they may not allow it simply because it's just not within their resources or time. So one of the things that's available is a prior written approval. It used to be called advanced understanding or advanced agreement. And it's just simply that all the parties come together and agree. Now, I have Paul's super secret method to get around that. You might say, well, that may not be right, but I wouldn't steer you wrong. When you do a budget, if there's something in there that, trying to explain that's a little unique that you could do through that, you can put it in your budget narrative. And if the government agrees to it, what do you think?
Yeah, actually, I was just working with a client on that specifically back in December. So we had a call. There were certain things within their budget prior that they attempted to submit reimbursable costs for. The government came back, said, no, that wasn't in your budget. We can't allow it. So I worked with them to write up their budget narrative and help understand and explain where all the fundings were coming from, what flow processes there were, what types of support activities and costs they wanted to include. So, you know, something as simple as a telecommunications line, right, for a nonprofit might symbolize and encompass a lot of different things, but to a government standard, well, maybe that doesn't take into consideration airtime when we're overseas, which it doesn't. So that was like, for instance, one of the things that the government did not allow. So we were very specific in writing in that budget narrative and what types of costs would be pulled into that specific line.
Yeah, in fact, I remember an IG person saying many years ago that there has to be a crosswalk, is their term, between the budget and the detailed GL accounts.
Right.
So if something, like you say, you have many, you better be more specific, right? Okay. Period for allocating cost is your organization's fiscal year, but just be aware that grants don't start and end in your fiscal year, which means they'll cross 2 fiscal years with 2 different indirect rates involved. Usually the agency with the highest dollar amount is the one that we do the negotiation. If you never had an negotiated rate and you want to, and you just got an award, you know, they usually say it should be within 90 days, although, so that's the rule there. Some organizations don't do it because they have caps and they can't do anything with it. Normally, if you have every year an ongoing rate proposal, you submit it 6 months after year end. I've seen one agency that said come back in 2 years, but they might say, but I have some stuff, I'm going to get an award or something where it's a little bit more current. I need a rate every year. So if they say that, you don't have to just do that. I mean, you can ask them, right?
Right.
Some people think that whatever the government says, okay, that's it, I'm done. If it doesn't help them, but you can talk to them.
What's been your experience though, Paul, when I've had a few of my clients and organizations who have submitted their trued up indirect rate, you know, within that 6-month time window, but then it literally takes years for it to be approved. Has that been kind of your experience, or?
Most agencies, it's usually within at least 6 months.
After submission.
Yeah, and HHS is 2 to 3 months. And when you seem like it's taking too long with HHS, people just call and annoy that you know what out of them. And it's amazing. They'll respond, okay, we'll put yours up there. Yeah. I mean, so the squeaky wheel sometimes works, but Department of Interior is way behind. I don't know if you've had any DOI stuff, and I'm not trying to blame them or anything, but they're way behind, and it is more than 6 months.
Yeah. It has an impact on our audits, as I'm sure you are aware, because we do have materiality that we have to consider. So if we have a true up, which we perform the audit, they do the true up based on those actual or indirects, but then they don't get an approval, and I'm going into the next year, and it's simply a provisional, so they're still not really sure if it's going to be accepted.
You put it in a footnote?
Well, I don't typically put it into a footnote. I would typically consider it an estimate, a management estimate at that point, and at least report it to governance that it's a significant estimate, depending again on how much it might actually be and the impact on the overall financials. But it does sometimes put not only us, but the organizations into a little bit of a sticky situation.
Wow. Yes, definitely. And you can see there's a determined rate, basically an estimate of costs. I'll get this. Hold on, everybody. Ooh. Okay. Then there's ceiling rates. They're similar predetermined, but these are the worst rates of all. And that's where the difference between the estimated and the actual costs are carried forward to the next year. And it's like a dog chasing its tail. Really, you'll never catch it. So the best one is a final rate. And it's based on actual costs for the period that just ended. Once negotiated, it's not subject to adjustment. And then the government typically takes your final rate and makes it the next year's provisional rate, which is used for temporary, indirect rate for pending final rate, used for funding, interim billing, cost reporting, you can see up there. So it's distributed to all participating agencies. And some people say, you know, for some of these smaller, unique agencies, you know, that they can't find where to submit, you know. And I think the best thing probably is either look at the clauses or maybe talk to the grants management officer, the person that signed it. They'll probably give you a hint of where it is.
All right, with that being said, we're now on our second polling question. And our question is, which of the following indirect rates applies to your organization? A negotiated indirect rate is with a federal agency that you have the majority of your grants. Is it A, we don't have an indirect rate and want to obtain a negotiated indirect rate? B, we are currently using the 10% de minimis rate and are happy with it? We are currently using the 10% and want to obtain a negotiated indirect rate? D, as a sub-awardee, we have established an indirect rate from our prime and want to obtain a negotiated indirect rate? Or is it E, our negotiated indirect rate has lapsed and we're considering applying again? Please take a moment to answer. While everybody's submitting their answers, I'll provide the second CPE word. Our second CPE word is federal. Remember, if you want to receive CPE credit, please jot these words down because you'll need them for the survey following our webinar. Again, the second CPE word is federal, F-E-D-E-R-A-L.
And it looks like based on the polling question, we have a pretty good spread of all answers,
Right.
about 21, 21, 13, 11, and 34 respectively with those poll questions. So, you know, we are here to help. So obviously for those of you that answered that you want to obtain a negotiated rate, hopefully you can reach out to us after this webinar and we can help you with that process.
Exactly. Or if nothing else, just answer a few questions that you may have. We're here to help.
Exactly.
Okay. And then we'll just go into one of the more common allocation methods. There are four. One is simplified allocation method, one's the direct allocation method, one is the multiple allocation method, and then the last is the special rates. But we're just going to talk about the simplified allocation method. So basically, it's very straightforward, where facility costs, all your facility costs remain in the facility and administrative rate, your G&A or your M&G. Boy, there are a lot of different of the same things. So the G&A allocation base, you know, is what they call modified total direct cost base. And it's labor, applied fringe, non-labor exclusions from it are shown in a couple slides. So you can use that. That's the total cost kind of base with a few exceptions. The salaries and fringe are just salary only. In the next slide, you can see that basically here we tried to make them like, this looks like to me a little purplish. And you'll notice that this is just on labor, direct labor itself. Notice the total G&A is 382,200. So when we do all of these three calculations, notice the numerator is the same, but the denominator can also be salaries and fringe, which is down here, or it can be the modified total direct cost base. But notice the larger the base, the lower the rate, or reverse, the lower the base, the higher the rate. Which one do you think, and we probably could have done a polling question, which we didn't, but you know, do you think is the best rate? And that's like, well, in the indirect world, that's like, what is the meaning of life? I mean, it really comes down to the real rates that most people understand are the ones that tend to be lower. So you see, you can't compare rates between, let's say, this is entity A and this is entity B, because they're doing it on different denominators and therefore come up with different results. They have to be apples and apples. To me, because people understand a low rate or they feel that they do understand it. I would always try to do this. Also, if there are caps, having a lower rate and the cap is, let's say, 10%, well, that would have the least impact on this versus this. So there's just a bunch of things to consider. You can see the components of the modified total direct cost base or salary, wages, fringe, materials, subawards, the first 25,000. Anything above it is removed from the base, and then there's like direct equipment, capital expenditures, rent that's direct, and on and on. Participant support cost.
Okay, excellent, thank you. And so before we wrap up, we are on our last polling question, and our polling question is both subcontracts and subawards over 25,000 must be removed from the MTDC base. And it's a simple true or false, A for true, B for false. So please take a moment to answer. While everybody's submitting their answers, I'll provide our final CPE word. The final CPE word is benefit. If you wish to receive CPE credit, please jot this word down because we will need it for the survey following our webinar. Again, our final CPE word is benefit, BENEFIT.
Okay, and so 76% of you answered true.
Both subcontracts and subawards must be removed. No, it's false. That's a common misunderstanding. And if you look in there, it precisely just says subawards and just federal subawards. If it's not a federal award, a subaward, you don't have to also even deal with removing the 25,000. I mean, if it's a private foundation grant, for example, or something like that, if it happened. So the answer stumped you all. It is false. There is no more sub. There never was. Some agencies, I think they're too, I don't know, less precise with their wording, and maybe they put in that subcontract, but it's not a requirement. Okay, and let's go to the last slide so we can begin to start to wrap this up. And basically, just remember that direct cost functions remain in the direct allocation base, though they may be unallowable. And that's fundraising, membership, promotion, lobbying, public relations. And then just to add the comment, the bid proposals, as you know, are allowable. They're not fundraising, but I understand under a 990 might be considered fundraising. But for OMB purposes, it's allowable and it's not fundraising. So we start to get into the very last questions.
Sure, yeah, thank you both once again. And before we wrap up, we want to answer some of the questions that were submitted by our online participants and any others from the room. So it looks like our first question is, you all mentioned that there are proposed changes to the uniform guidance. What are the significant changes that impact indirect costs or rates?
Let's see that. And then this is from them. I'd like you to do. Yeah, the significant changes to the indirect rates really is just what we said about the de minimis rate and the fact that the de minimis rate, the change in the fact that you have a break in relationship, and that is a change. So that if you have if you had a negotiated rate, they're proposing that even if there's been a break, you can go back to a de minimis if you need to.
Yeah, and just to give a quick little resource for you all, if you do go to our website, www.grfcpa.com, we recently also published a white paper on some of those changes for OMB, probably I think about a week and a half ago when those when that did come out. So currently, again, it's in the proposal state. I think the commentary is open until March 20th, I believe. But there is a nice white paper that kind of outlines exactly what those proposed changes are and what impact they would have on the federal government.
Okay.
Go ahead, read the first question.
Another question that came in. So for direct charging of admin staff, what about the consistency issue, meaning charging the same type of work consistently, either as direct or indirect?
That's a good point, but one slight thing that's missing, and that is the purpose of the cost. So yes, you can be consistent, but if a person, it's not inconsistent, let's put it this way, if the purpose of a normal indirect purpose, a person then starts to charge direct, the purpose has changed because it relates directly to the grant. And this often really only happens in small entities, my belief, where people wear many hats.
Mhm.
So it pertains to the purpose of the cost, and therefore there's no inconsistency. But it's a very good question.
Got it. Okay.
What about the next one?
Excellent. What about, so what's a good approach for recording allocation of indirect costs to different programs, grants, contracts, what have you, in an accounting software other than Excel?
As far as, you want to answer?
That is a tough question. So I can say, you know, I've seen a number of different ways for this to be recorded. Every time a drawdown occurs, the indirects get allocated out and are charged up that way. They're trued up monthly. I have some clients who are, for instance, on, I believe they use Deltec, which is a very robust system, and again, would only typically be used by very sophisticated, high dollar value nonprofits, but you can actually build out your indirects within that system. So I think one of my typical responses to this is just to reach out to whomever your vendor is for your software to even see if that's a functionality that can be done. I know Microsoft Dynamics Nav does that as a for instance. I believe that is one accounting software that allows it. I've also seen some, I don't want to call it an antiquated system, but I've actually had some organizations who have done and built out access queries to be able to pull what those costs are based on different chart of accounts within their general ledger and be able to calculate that, and then based on that query, it also then gets recorded and put back into the GL. So that's someone who I think had a little bit more time on their hands and were able to actually build out the access query. But, you know, those are just some suggestions. Again, a step one, I think, is just even seeing if your software vendor has an ability to have a function built in for you. That would be step one for me. Number two is that you would have to calculate that yourself, and then you would just have to record it.
Also, I think it's important to understand that you have a provisional rate. If you're dealing with, if you have a negotiated rate, then you have a provisional rate, right? And the provisional rate is your standard, basically. And so the accounting system continues to record the actual costs the way they are. And then later there's a true-up process. So again, if you know your provisional rate's really high and you're going to be having cash that you otherwise would have to pay back,
right,
then you can voluntarily get it closer to where, you know, that on your draws to make it lower.
Right.
So there are a lot of things, but again, try to keep it simple.
Okay. Okay, excellent. Thank you. What about, so is the allocation of time spent on grants based on the level of effort stated in the budget allowable, or must the allocations reflect what is documented on the timesheets?
Well, the timesheet is the support of what you're allocating. The timesheets don't direct anything. They're just a record of what you're doing. What really is dictated is the grant itself. So if, you know, you're saying, again, a multi-purpose person, and that's probably the way to say it, an accountant in a small entity is multi-purpose doing different things. They can then do direct charging for a direct purpose. And that should be reflected in the grant budget. So there's approval and everybody knows what you're going to do. What would you say, add anything to that?
No, I think that's about spot on from my perspective. I do know that I work with some organizations where the grant agreement in and of itself basically only supports salaries and rent, for instance. So they are fully supporting one person because that one person, that's all they solely do is work on this one program.
Right.
So, you know, from that perspective, things may be a little bit different if we can get around a job description that solely supports you know, that 100% helps as well. But, you know, as Paul did mention, that time and effort documentation is still important, but having it in the budget.
But it doesn't direct anything. It's
right.
a result. It's to prove what you did.
Correct. Yeah.
Okay. What else do we have?
So another one that I have is, so I've seen the proposed changes in the Federal Register, but it's difficult to read. Is there a better version out there somewhere?
There is. OMB has put out a red line version so that if you ever seen anything in the Federal Register, it's very hard to read because they have three columns.
Right.
And it's like goes up one, down, up the other, and it's just total misery. So they do have a red line version, and if you want to put in your comments, if you're interested in getting that version, I'm sure we can get it to you. Just let us know.
Perfect. Okay, and then looks like last question. Why should universities, hospitals, state, and local units of government be concerned about nonprofit indirect rate proposals?
I believe it's a very good question, by the way, but I believe that they're the people that are monitoring their subrecipients, and most of their subrecipients are nonprofits, and therefore it behooves them to understand how the indirect rates are put together, how a nonprofit works structurally, and so forth. And in fact, we've had people call us from state governments, after a presentation like this, and ask us, does it sound like we're doing the right thing, kind of thing.
Mm-hmm.
And I find that a lot of the people at the state governments are very hardworking, friendly people, and they just want to make sure that they're doing everything correctly.
I think one of the other things too, just to mention there as well, Paul, is also before they even step into an executed agreement with those nonprofits to understand what they're doing from an indirect standpoint, right?
Mm-hmm.
So
Yes.
What are they going to be charging? What are they required to honor? And making sure that they can support that.
Absolutely.
Okay, well, excellent. Thank you both. I think that's all the questions that we had come through. Remember, to the participants, if you have any other additional questions after today's webinar, please reach out to us. Our contact information was on the prior slide. And with that, we'd like to thank everyone for attending today's webinar. We encourage you all to follow us on social media at grfcpas.com and visit our website at www.grfcpa.com for upcoming events and alerts. Please remember to complete the survey that follows if you'd like to earn CPE credit for attending today's webinar. Thank you all once again for attending, and have a great day.